2 minutes before close. I want to do a review real quick. If you watched the video last night, obviously you know that I went through something as a routine, something that you should be doing on the regular, looking at past data, something that's already happened in hindsight. In keeping with trying to show everybody they're wrong this year, I went out this morning and I was talking to my sons in group chat, and I told them that I felt that we were going to see it slam down after the run at 9:30. So true to form, you saw me do the execution, and I sped it up so that way you can put it on X. And the daily chart, I talked about the suspension block. Okay, so we talked about this last night, and these two volume imbalances, this one here and this one here, within the run of this buy-side imbalance, sell-side inefficiency. That is the true inefficiency. When we're looking at the daily chart, we're trying to get a feel for what they can do from a destructive mindset. Where can they go after people to purge their position, run their stops, acquire their position, and then run the other direction? Or we're looking for a continuation of an existing move. So what we're looking for here is this range needed to be considered. And we already dropped down yesterday, and I told you this booger was going to drop. And they ran it all the way up to a premium fair value gap. This happens to be right before you turn over. If there is a gap on the left side of a swing high, now here's for your notes, okay? I'm going to give it to you early. I've taught this before, but as a reminder, what you're seeing is when there's a swing high that forms, if there's a fair value gap on the left side of it or on the buy side of the curve, and before it rolls over and starts to go down the other side, I'm going to go with this side over the right side, meaning you can see there's two of them. When we're looking at a volume imbalance like this, and we're in a swing high, I'm going to use this candlestick's wicks high and that volume imbalance high, and I'm going to call that a fair value gap. Another PD array. I'm just throwing them out here this year, aren't I? It's going to act as an inversion fair value gap. Why? Because it's part of the buy side of the curve before the market rotates and goes lower, as I indicated it would last night. Okay, so not only did you have a bias last night, I told you it was going to drop. I'm not interested in going long. And we're going to see a contrast between when do I like the fair value gap on the right side of a swing high, which is your model 2022, or a turtle soup false breakout. So you got to find a short-term high, then another short-term high higher than that, and then it rejects that higher breakout and then pulls back into the range. We do not need it to be in a complete reversal. We just need it to give that characteristic. And the first presented fair value gap after that is the one you want to carry forward. Now, in a fractal sense, okay, like a small pattern that can be amplified in the higher time frames or reduced down to the smaller time frames, it's essentially model 2022. It's the cookie cutter that I taught you in model 2022. But I didn't teach you in the model 2022 to keep that fair value gap and extend it in the future. That is what I revealed last night. That is that little tiny piece of information that's just like, that's really good. And you don't appreciate it until you go back and start looking at your charts and collecting the information. It's like, oh my goodness, there it is. Yes, consistency is within reach. So when there is a fair value gap on the right-hand side, and that would look like this. We had the volume imbalance down here. That candlestick's close, this candlestick's open. So that separation between the two bodies, that's my volume imbalance. And then the candlestick's high up here. The gap here, normally, you could see this, it's working too, but I'm personally, me, Michael, I'm going to be looking for the inefficiency, if it exists, on the buy side of the curve. That one is going to be much more sensitive and more precise, in my opinion, than that of the fair value gap that's over here, because they can wick through this, kind of like what you saw intraday when I was taking my short. The buy side of the curve, any inefficiency that I have on the left side, I'm going to use that one over and choose that one over and above any fair value gap over here on the right-hand side. Now, here's the problem. This is what's going to be the downside to this. I may not get my fill because there may be a smaller fair value gap that's lower than this one would be. And it might just use that and never get up to the one I'm aiming for, and my limit order never gets filled. So barring just simply being wrong and the market just goes right on through, and that's always the case. I mean, you have a chance of always having a losing trade. But in the grand scheme of things, I'm going to side with any inefficiency on the buy side of a curve of a swing high if it's there. Okay, so now I've taught you two more PD arrays, two different approaches to using things I've already taught, but it's a small little twist in how you can use the information and how it's useful. No, I'm not interested in this fair value gap. But you can see how we went up into that and notice that it failed to get to consequent encroachment. Just fell short of it. Is that strength? Not at all. It's saying, I can't get there. By having this on your chart and then understanding that we are likely to work inside this range, that daily Buy side imbalance, sell side inefficiency that has two volume imbalances on it, which makes it a what? Suspension block. Volume imbalance at the high end of it, volume imbalance at the low of it. In addition to that, we have this wick, which was the highest one in this swing high here. As price was dropping down, you would use this range initially until we get through this candle's open. Then you have to use this wick because this wick extends below that candlestick's opening. It goes lower. So this is all a gap. This wick here, you need to grade that just as you would grade this one. Okay, and that simply is this. What we're doing is we're putting the gradient levels on this wick. So we're grading it upper quadrant, consequent encroachment, that blue line, and then here's the lower quadrant. Look at today's low. So we're going to leave that there. I'm going to take the other levels off. So just be mindful that this level here, 25,267.5. That's this quadrant level. So the market opens here, has this ridiculous rally up into an inversion PD array. It's a premium array. So it trades up into that. Some of you are thinking, I used this ICT, and is that wrong? No, it's not wrong. I'm just saying that if there's an inefficiency that I can incorporate in the price action over here on the buy side of the curve, then I'm going to use that one over anything that would be on the sell side of the curve. I want the more hypersensitive PD array. That's essentially what I'm trying to get at. This is the one I'm going to choose. So if you had this, there's nothing inherently wrong with that. If you didn't notice this because you're getting old like me and your eyes are failing and you had your fair value gap, something like that, okay, it still got up in there and did that. And then if you use that as a means of entry, then wonderful. Okay, there's nothing wrong with that either. But if you're going to be a purist in my concepts, you have to make sure that you don't disregard the volume imbalance if you're doing that, okay? So anyway, let's put it back the way it was. That's the range, that's the level I was keying off of. I'm going to show you what's in my mind, why I was looking for this whole premise today. Last night I told you the booger was going to drop, and it did. So we cleared the Thursday's low out, but it was a really wild day. You notice that? And they're still tradable. So let's drop down into the 1 minute chart. I had discussed with my family members and my best friend, I had told them that I was looking for 25,567.25. That was the price level I gave them today. That's essentially the half of the opening range gap. So you can see right away why I don't have all this stuff on my chart. Because even though you may understand what I just disclosed and talked about on the daily chart, by having that information and then bringing it down to lower time frames, and you're looking at all the other things like new week opening gaps and new day opening gaps, and now I've given you Turtle Soup highs and lows in the first presentation of a fair value gap after that, continuing that. That's why it's important for you to have workspaces. So we have a lot of things going on in this chart. But when we're looking at the chart through the lens of a regular trading hours chart, that's this range right here, where we opened up here and where we settled here. So if we take that, measure it. All right, so here's the halfway point here. I'm just giving a rough idea where my children are being coached by me. So in the morning, what I'm doing, so that way you can do the same thing. By having an expectation that the market's going to likely pull down into half of this gap, even though it went past 10 o'clock in the morning, I still think it's a viable option to decide on going short versus going long, because that daily suspension block that's shaded in green here is such a big elephant in the room. You just have to be aware of that range. That's this level down here. That's that lower quadrant level. Look how far that is away from where we opened up here. Because I'm trying to teach them, I'm teaching my sons very easy, low-hanging fruit objectives. What did I teach you about the opening range gap? Half of that gap's range, 70% of the time, you're going to get it filled, or it's going to trade back to it by 10 o'clock in the morning. But if the higher time frame chart is indicating that it's bearish, by having the minimalist approach to trying to find a framework for shorting or buying long in the marketplace during the opening range or during the first hour of trading, it's my endeavor to kind of press my family members and my best friend into a mold just for the initial approach of simply looking for how to trade the morning session using the opening range gap. Always focus primarily on half of the gap. Okay, don't look for a full gap closure. That's something they can evolve into, just like you can evolve into. So the only thing I've been doing is bringing their attention to what half the gap is. That's the reason why I told them I wanted 25,567.25, because it's just below. If you look right here, I wanted to see it dig down into the gap and print just a little bit through it. So in here, I just gave a rough idea where that should be. That was where I was aiming for. Could I have done a full pull? Sure. But I'm not trying to babysit it because it's not that big of a deal to me. These things happen all the time for people that know how to use my stuff. For you that are new, it's not so easy for you to do it. So I understand you want to know everything and expect to know everything the first time you look at it. And that's not going to happen here. Okay, it's too much technical science, and I'm not trying to be facetious about that. It really requires you to be diligent about keeping notes and knowing what you're looking for. Now, I can turn this into rocket science, but all the things I offer and how you can frame a trade setup are actually very simple. You're only looking for a couple moving parts. Don't be discouraged because you can't do it as fast as you want to do it. But that fair value gap up here, which is the inversion fair value gap on the buy side of the curve of that swing high in the daily chart, that's what this area is here. I'm waiting for it to reach up to that. As it's reaching up into this, because it simply just blasted up through an old buy side liquidity pool, that's this over here, these relative equal highs. What makes it high probability or a good candidate for it to be rated? Because the right-hand side low is slightly lower than that one. So the relative equal, buy side's resting above that. Market's going to rip up there, go into that premium inefficiency from the daily chart, run out everybody, and then this is the secret sauce you're looking for. Why did I do this today? First of all, it was the run to this. See that high? This candlestick right there, 9:48 a.m. That high has a lower high to the left of it, and it has a lower high to the right of it. So what does that make that? It's a swing high. The point is, this short-term high here, when it gets pierced like that, and it goes into a premium array that I'm aiming for and waiting for, I want to see it then break down. This right here, that swing low being taken out, that sets the stage for this being model 2022. So that fair value gap right there, let's add it to the chart. Close comes in at 52 and a quarter, open 52 even. So yeah, there's the volume imbalance. Notice that the bodies are staying basically inside of that inefficiency. But when it was wicking above, that was not scary for me because I know that it's just simply referring back to this old swing high. This old high here, because it was a means to an end on the run up, all it's doing is algorithmically referring back to that same level there, getting that last little bit of liquidity because it only spends so much time here and then it runs away. You ever watch the market and say, okay, I'm going to go in here and I'm going to put an order in, and then it just completely leaves the range that you were trying to enter in? What are you left to do? Either chase it or put an order back in there and see if you can get another stab at it. Well, that's exactly what the algorithm's doing right here. That's all it's doing. That little bit of a wick in there like that. This is all permissible price action. I teach that as a Mohawk. But the bodies are staying inside there. So what is that telling me? I know I'm right. The market's staying inside this fair value gap, indicating that, yes, we are seeing it color outside the lines, but it's only referring back to here. So when this was happening live, and you can watch this on the recording, I'm not concerned about it, tearing off. I'm not worried about that at all. What I'm trying to do is I'm trying to get inside of this range here that's shaded in red, and I'm trying to secure entries above the midpoint or consequent encroachment level. That's what I'm focusing on. And figuring out as soon as I get that, where we're going to trade at next. And that's this first presented fair value gap. Now, because we've done this short-term high, ripped its face off, then it created the model I explained last night. High, higher high, failure. That's Turtle Soup. The first presented fair value gap that's forming on there, you want to extend that. Well, in this case, we just traded right up to that. So that's going to be an immediate trade. And I want to see it trade back down in the first presented fair value gap. But here's the caveat here. Because we've had multiple stages of buy side taken, this was a lot of manipulation in here, going into a premium array. And then if we return back to the first presented fair value gap, and because I'm bearish and I'm looking for mid gap to come down to these levels here, I want to see the first presented fair value gap offer no resistance on the downside. When you watch the commentary, this is the only thing you saw me put here. I didn't want to, when it got to the low of it, I don't want to see it go up into that area here. No bodies up there at all. None. Zero. And I wanted to see it just rip through. If you watch the video, you'll see me having this low highlighted with this. All I did was took this comment here in this little line that was originally anchored there. Once it ripped through it, like I wanted to see it do this very thing right here, it did it. Then I immediately took that line and put it down here, so that way you can see that I was wanting this level to give up the ghost quickly. I wanted to see speed below that. And the only mention I made about the inversion aspect of this first presented fair value gap, which is this candlestick, by the way. There's your first presented fair value gap. Because I'm bearish, I'm expecting lower prices. I want to see the opening range gap be a factor for drawing price lower. I'm only looking for half gap. So consequent encroachment is where I'm reaching for. I'm teaching my children to use that as their draw. And don't expect to try to make more than that. But take partials before it gets there too. Anyway, it just slices right through first presented fair value gap. And now look what it does here. It gives you confirmation at the consequent encroachment right there. Okay, this candlestick's wick goes up to there, just above the midpoint, and then gives up the ghost and goes lower and closes outside and below the low of the first presented fair value gap. Then this candle here opens up, trades up to it here. Now, if it would have hit this or went into the lower quadrant level or wick to that, I would have added. That would have been a beautiful entry to add to. It didn't go there. It just stops short right there. So there's a little space between this candlestick's wick and the low of that orange box, which is my first percentile fair value gap. It's going to act as an inversion fair value gap if it can go there. But did it get there? No. So what did I teach you about real order flow? I'm teaching you to be the weatherman that forecasts the weather in the future. You're a prognosticator. You're a fortune teller. You're reading the future. We ripped through first percentile fair value gap. There was no even considering coming back to it here. So that's indicative of what? Heaviness. That means it's really, really bearish. So the note was, I want to see speed under this low, just like I had it here. Well, here's the low. It rips through it. Can't even come back to touch that low. It doesn't even get there. So that also is what? An old low that can't even be retested. And then it starts to sell off again. Where's it going to go? Half gap. But now it gets down here and it's been a straight run from my entry candle. There's my entry right there. Look at the top of the range right in here. Look real close, guys. You see that? And right there at the consequent encroachment level. I know what I'm looking for. I don't need to know yesterday's numbers. I don't need to know the number of contracts that were bought and sold at a specific price inside of a candlestick. The market gravitates down into close proximity to that half gap, that blue shaded line here, okay, which I roughly called regular trading hours, opening range gap, consequent encroachment. So I wanted your focus to be generally in that area here. And as we got close to it, I was teaching my sons, when you're in a trade and it's getting real close to your target, and it's been a straight run since you got in, so you got a really good fill, it just starts to really rip and tear towards your profit. And as it gets to your target, it just feels like this overwhelming sense of, oh, please just get to my target. Please, please, please just get to my target. And you don't even want to be in the trade anymore. You just want to puke your guts up. You're like, I've had enough of this. I'm making money. I'm in a winning trade, but I can't stand to be in it. Just please let me just get out of this. And you just want to get out of it. It's claustrophobic. Well, you don't ever feel that until you trade with real money. When that experience comes over you, when your trade's getting ready to hit your profit target, and your limit order is sitting right there ready to get hit, you're 10, 15 handles away, and you're like, man, it got there really fast. And now you start guessing about whether or not it's going to hit it or not. So the first thing I taught them to do is, as soon as you feel that, and it's going to happen in close proximity to your target, just simply take something off. You're going to feel like a weight has been taken off your shoulders. It's going to feel like you completely have opened all the windows in the house and you can breathe fresh air now. It's like all of a sudden there's oxygen in the room because you were suffocating prior. And as soon as you take that partial, move your stop. Don't give it any more room to come back and take all of the remaining lines portion of the trade. And every time it takes a swing low out, find some way to chase and run down equity. That means move your stop a little bit lower. It doesn't mean strangle it and only give it 3 handles of movement. Give it some movement closer to where price is at. So every time it creates another swing low and it trades below it, or it has an elongated candle, it breaks below that like it does here, I want to lower my stop. I'm not saying I'm going to jam it down here. Just watch the video. You'll see how I manage the execution and the existing profit. Never let a stop loss go stale. Meaning, if you've adjusted your stop loss, whether you've taken a partial profit or not, during the life cycle of your trade while it's open, you haven't closed it yet, every time it makes a new equity high, find a way to adjust your stop closer to your exit. Never let the stop loss go stale, because you're going to be sensitive about managing your equity if you do things like that. You're not being hypersensitive. You're not being scared. You're not being laden with paranoia. It's simply you being mindful of the money. You're constantly increasing the payout for you. Don't let your stop loss go stale. If you're going to do partials, then you can be a little bit more liberal with leaving the stop, where you first adjust it. But if you start seeing any type of overlapping of PD arrays, then in these market conditions, they can send this thing just like that and completely erase your unrealized profits if you left it just at a break even. Just be mindful of that. If we ever go back to a more normalized market environment where the volatility isn't breakneck speed and type things like we've seen recently, then you don't need to trade with such a degree of sensitivity and worrying about making sure you're squeezing every little last drop out of the trade. But if you're new, if you're developing, it's not a bad thing to do going in. Because if you get stopped out of winning trades and it only went a little bit more, that's actually a good thing for you to grow into. Because making money and being consistently profitable is stressful in the beginning, because you think it's going to stop. You think it's too good to be true to continue, and you start thinking about things more than you should. You second guess everything. So to avoid all that and to compensate for those normal human characteristics, we are the greatest critics of our own performance. I'm the greatest critic of my own performance. There ain't a troll out there that's going to make me feel bad at all, ever. But I can make myself feel bad if I spend too much time critiquing what I did or didn't do, how much I didn't buy or sell, how much I didn't move the stop when I knew I had an unction during the time of the trade. I knew I should have did this, but I didn't. And if I think about it, it'd be like that little piece of meat between your teeth. Your tongue keeps going right back to it. To avoid that, I just simply, when I'm done with my execution, when I'm done with my trade, I do my annotations, I do my little notes in my little journal, okay, and then I move on to the next one. And then I'll revisit on the weekend, and that's it. That's all I do. And I've been doing that for decades. If I'm teaching you to do it, and it's something I do, and you want to trade and execute like I'm showing you that these concepts afford me, there's no shortcut to it. We rip through the half gap and create a short-term low here. We come right back up above and sweep consequent encroachment mid-gap of opening range. Break lower, trades all the way down into the lower quadrant of the daily suspension block, this green sheeted area here. That's the lowest quadrant, and that's the low. That's the halfway point, upper quadrant, and the high in the box, okay? What are we creating here? What's this? Relative equal low. So we have a low with a higher low to the right of it. So that's a high probability candidate for a sweep on liquidity. And the market does trade down through it and goes right to, look at this. This is probably worthy of the X-Files. Seriously, look at this. Look at the bodies right there. You see that? The bodies are stopping just north of that level. This one sweeps through it just by a little bit. And this one has just a little bit of a hair of a tick below it. But the bodies are not touching that. So what do you think happens when the market trades above this last down close candle? It's going to become an order block. Market rallies up, comes right back down into mean threshold. That's weird. And then the market rallies up, fair value gap, trades into it here. Smart money reversal, low risk buy, consolidation, reaccumulation, second stage reaccumulation, and that's the nicest run off of it, clears that high. So it's a market maker buy model right there off of a quadrant level on a wick on the daily chart after trading lower on the day. So I have fun with it while I teach all of you. So it's kind of like a balancing act for me. It's boring for me just to teach. I have to have some kind of a fun playground environment, and that's what I do. So I leave it up to you. If you're really diligent about trying to learn how to do this and the things that I'm teaching, you will see value in it or you won't. And if you can't see value in the levels of precision, for instance, we have this range that's shaded in green. That's that daily suspension block. If you grade it, here's the upper quadrant, the midpoint, consequent encroachment, and here's the lower quadrant and the low of it. This is that one daily wick. I told you that we were going to grade the lower quadrant level. That's that turning point right there. Having these levels on your chart with annotations in a workspace, so you're going to toggle through. If you're just looking at one chart all day long and you have no reference points, as I'm teaching with my PD arrays and how to use a higher time frame chart down to lower time frame, you're going to have moves that happen that's going to surprise you. It's going to be like, where'd that come from? Why did they do that? I'm never surprised unless they come in there with a geopolitical type thing. That's when I'm like, wow, that's something I didn't see coming. Otherwise, I know what I'm personally looking for. And that takes a lot of time and experience to get to that place in trading. It took me about 10 years to get that. Some of you are probably way smarter than I am. And because I'm teaching you my concepts and because you're smarter than me, if you listen to me when I'm talking about the psychological aspects of what you do and what you should not be doing, you have the advantages of growing faster than I did and not put yourself through all the pain and misery that I did. So I'm giving you the best of the best. It doesn't feel like it when I'm entertaining myself with trolls and whatnot, but I love converting people that are hard and stiff-necked people. Because if I can convert you when you were so fixated about this isn't how the markets operate, or their stuff is better than what I'm using and I should use this, and there's nothing better than what I'm doing. Who out there can tell you these turning points and why it's there, and it keeps happening all the time outside of my stuff, because this isn't anywhere else. We're talking about over 200 handles today, just of a complete washout on a market that I guarantee the majority of you that were watching it this morning when it was going up, the last thing you were thinking of is we're going to trade down to that level right there. And I'm trying to challenge you to think about that's how these things work. That's exactly what it does. It goes to these predetermined levels. It's not limited just to the quadrants. You can break it down into eighths, and then you get really stupid with the precision.